What's up, traders? It's Rishi, and welcome back to Investeen. On this episode, we're going to be covering the second letter of CANSLIM, which is A, and that stands for annual earnings. Let's get into the video. As we analyzed in the last video, current quarterly earnings play one of the most crucial roles in finding extraordinary stocks using CANSLIM. Some stocks may have been seeing extremely great quarter-over-quarter growth in the short term, making them look really attractive to buy from investors. However, this may have just been some one-time occurrence, with no past evidence to show that the stock is reliable and stable. Stocks with consistent and accelerating growth in their recent annual earnings, alongside strong quarterly earnings growth, are way more likely to explode upwards in price in the longer term. Obviously, the best of the best stocks will have shown larger than predicted movements in annual earnings. For CANSLIM, O'Neill suggests that annual earnings growth rate should be at least between 25 to 50%, but those rare and extraordinary stocks will hit 100% or greater growth. In some cases, the annual earnings 1 year out of the 5 years that are being analyzed can be down, just as long as the earnings of the following year after the downtrend reach all-time highs once again. An increase in the earnings to an amount that's still lower than all-time high annual EPSs isn't as strong enough of a signal for booming growth that we're looking for in the future. So in this case with the sample data, we can see that there was a 20% decrease in the earnings per share from year 2 to year 3. However, in year 4, we can see that the annual earnings per share had reached all-time highs once again, as the year 4 EPS is greater than the previous all-time high, which was at 88 cents for year 2. Because the earnings is hitting all-time highs, this is a signal of booming growth that can happen in the future, as the year 5 growth was also extremely above average for that annual EPS growth that is suggested as a minimum of 25 to 50%. William O'Neill also discusses 3 additional metrics of profitability to take a look at, which are return on equity, cash flow, and earning stability. Return on equity, or ROE, is found by dividing the net income of a company by its shareholders' equity, showing the profitability of a company based on the equity or capital that's invested by shareholders. William O'Neill says that the greatest growth stocks from 50 years prior to the early 2000s had a return on equity of at least 17%, with those superior stocks that we talked about showing a return on equity of 25%, all the way to 50%. And for cash flow, many growth stocks that saw huge price moves had a cash flow per share that was 20% larger than the actual annual earnings. In our quest of finding the best stock, making sure that annual earnings are stable and consistently growing is extremely important. IBD offers a metric called earning stability, which is scored on a range from 1 to 99, where lower numbers are better signals of growth stocks, preferably below 20 to 25. Companies above 30 for their rating have a past earnings record with the lower stability. The best stocks may even have earnings stability in the single digits, like 1 to 5, when earnings growth is explosive and consistently accelerating at above 25 to 30%. To apply this to the real world, let's analyze Meta platforms. Starting off with some technicals, Meta has seen some price rises of 70% since late June of last year and 41% since the start of 2024. This pullback and the consolidation is creating a strong base for Meta, and the stock has been in a solid uptrend since late April, creating this cup and handle pattern. I'll go over the price patterns that are sought out by investors using the CANSLIM strategy in future videos. Now, moving to the fundamentals, the past quarters have seen some solid growth, with some vigorous upward movement in the 2023 quarter 4. Now, they did see a downtrend in 2022 with both the EPS and the price, but the annual EPS did reach a new high at the end of the 2023 year, higher than the previous high in 2021, which was $15.56 for 2023 and then $13.77 for 2021. Earning stability is pretty solid at 24, signaling stable and consistent earnings. Their return on equity is also above average from the baseline 17%, sitting at 29%. Finally, their EPS rating is a 97 out of 99, meaning that Meta is outperforming 97% of all companies in terms of recent annual and quarterly earnings performance. Overall, I would definitely say that Meta is looking pretty strong for its fundamentals and technicals. Now, let's finish off with one last company, which is the computer networking company Arista Networks. Really strong price action with a solid uptrend since the outset of the pandemic, making the price rise by over 7 times its 2020 value. It is consistently beating all-time highs as the weeks progress, showing the exceptional potential for its growth. We can really see great quarterly earnings backed up by strong sales as well, with the last quarter's earnings per share beating analyst predictions by over 14.5%. The actual annual earnings per share that has been reported is consistently beating that 25% minimum for the CANSLIM methodology. Arista has super solid earnings stability, being under that 20 to 25 range, sitting at 17, with a strong EPS growth rate as well, sitting at 29%. There's a phenomenal return on equity, which is more than double the minimum 17%, sitting at 36%. And to end it off, their EPS rating sits at a 98 out of 99, meaning that Arista is outperforming 98% of all companies in terms of their recent annual and quarterly earnings performance. Thank you so much for watching this video. In the next episode, we're going to be covering the letter N in CANSLIM, which stands for new product or service, new management, and new highs. See you in the next video.